There's a sequence to investing 6 moves in a specific order, and doing them correctly is worth conservatively $400,000 more at retirement than doing those exact same moves in the wrong order. Same income, same market, same decades, the only variable is the sequence, $400,000. That's not inspirational math, that's real math, and I'm gonna show you exactly how it's constructed. Most financial content gives you a list. Do this, and also consider that, and maybe think about this other thing. Lists are useless because they have no dependencies. A list doesn't tell you that step 2 destroys step 5 if you do them out of order. A sequence does. And what I'm going to give you today is the sequence, 6 specific levels, each one mathematically justified, each one unlocking the next, that the people who actually built real wealth followed while everyone else was talking about their stock picks. Here's the stat that cracked my brain when I first saw it. According to Federal Reserve data from 2023, the median American household holds about $5,000 in liquid savings. $5,000. And simultaneously, same households, same demographic average credit card debt sits north of $7,000 at over 22% interest. These people are earning maybe 4% on their savings while paying 22% on their debt. That's a net loss of 18%. And they're calling it financial responsibility. You want to know what the right order actually is? You already clicked. So here it is. There are 6 levels. Most people are trying to play level 4 before they've cleared level 1, and the game doesn't give you extra lives. What I'm going to walk you through is the exact sequence that maximizes every dollar you commit to building wealth. Not a philosophy, not a vibe. Each step has a specific mathematical reason. It comes before the next one. And the reason this has gotten so broken is straightforward. The financial media has every incentive to talk about the exciting stuff, stock picks, sector rotations, crypto, options, and basically zero incentive to explain the boring foundational mechanics that actually move the needle for 90% of people. Boring doesn't get clicks, but it absolutely builds wealth. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They ignore tax, drag, sequence of returns, risk, and the compound effect of fees over time. It uses BlackRock and Vanguard methodology to find the real weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Now let me give you the central idea that's going to hold this whole video together. Think of this like the skill tree in an RPG. In those games, you have a web of abilities, some foundational, some advanced. The advanced ones are gated. You can't unlock Master Sorcerer until you've unlocked basic spellcasting. The game enforces the sequence on you. Your financial life works exactly the same way, except nobody enforces anything. You can invest in individual stocks before you have an emergency fund. You can open a brokerage account while carrying 22% credit card debt. The game lets you do it. The game also quietly destroys you for doing it. It just never tells you why. I'm going to come back to this skill tree throughout the video because every step we hit is a new level unlocking. And every time someone asks me why the order matters, the answer is always the same. You can't skip levels. The later skills look cooler. Nobody brags at a dinner party about their 3-month emergency fund. Everybody brags about the stock that tripled. The psychology here is the real problem. The math is easy. The behavior is where it falls apart. Here's what you probably think the problem is. You think the problem is that you don't know the right investments. If someone would tell you the right index funds, the right allocation, the right sector, then you'd be set. But that's not actually the problem. The problem is that you're trying to optimize level 5 when level 1 is still broken. You can execute level 5 perfectly and still lose money because the hemorrhage is happening 2 levels upstream. That's where we start. In a few minutes, I'm going to show you a number that will make your employer's 401k match feel like a crime scene. But first, here's why the foundation matters more than any investment you'll ever pick. Level 1 is the emergency fund. And I know you've heard this. Stay with me, because what an emergency fund actually isn't what most people think. Vanguard published research showing that households with at least $2,000 in liquid emergency savings reported financial well-being scores 21% higher than those with nothing. The interesting part isn't the size of the gap. It's that the inflection point was $2,000. Not $20,000, not 6 months of expenses. $2,000 is the threshold where your brain stops treating every incoming bill as an existential threat. And when your brain stops panicking, it makes dramatically better long-term decisions. This is the psychology of money working in your favor rather than against you. Small numbers with outsized behavioral impact. Here's a story that makes this concrete. There's a guy I know through business circles, financial analyst, MBA, sharp with numbers. He spent 3 years consistently investing $500 a month into a low-cost index fund. Disciplined, right approach. Then his car transmission blew. $4,000 repair, he didn't have it liquid. So he sold a chunk of his index fund at a dip, naturally, because emergencies love to arrive when markets are down, paid short-term capital gains tax on the withdrawal, and spent the following 8 months rebuilding the exact position he'd held 2 years earlier. He lost 8 months of compounding progress to fix a car. A $2,000 emergency fund would have changed that outcome entirely. The target to start is 1 month of essential living expenses minimum. Not 3 to 6, that number paralyzes people into never starting. 1 month first. Park it in a high-yield savings account. As of early 2026, you can find 4 to 4.5% annual yield on these without much effort. Once you have 1 month, keep building. The emergency fund is the drain plug. Without it, everything else you pour into the tub leaks out the moment life decides to show up uninvited. Level 2 is high-interest debt. And I'll give you the math directly because the math is what makes this undeniable. If you have $8,000 in credit card debt at 22% interest, paying it off is equivalent to earning a guaranteed 22% return on your money. Guaranteed, tax-free. Zero market risk. Warren Buffett's long-term average return at Berkshire Hathaway is roughly 19.8% annually. Paying off your credit card debt is mathematically outperforming Warren Buffett. I don't say that to be clever. I say it because it's precisely true, and most people have never framed it that way. The Federal Reserve's 2024 data shows Americans collectively carry over $1.1 trillion in revolving credit card debt. Over $1.1 trillion at over 22% average interest. People are sitting on a guaranteed 22% return and choosing to put money into index funds hoping for 7%. The method that saves the most money is the avalanche. Pay minimums on every debt, then throw every extra dollar at the highest interest balance first. Some people prefer paying the smallest balance first, the snowball method, for the psychological win. Fine, use it if you need it. Know that you're paying a premium in extra interest for that motivation, and decide consciously whether it's worth it. The avalanche saves more money. The snowball saves more people from quitting. Pick your trade-off. Now, once you've plugged the drain and stopped the bleed, the game changes entirely. Because level 3 unlocks something that is, in my opinion, the single most underappreciated free money mechanism in American personal finance. Stay with me here, because this is the part of the video that will actually change your behavior, assuming your employer offers it. The 401k employer match is a 100% guaranteed return on your investment, up to the match limit. Read that sentence again. 100% guaranteed. Before the market has done anything, before you've selected a single fund, the moment your contribution triggers the match, you've doubled that dollar. No other investment on earth offers this. And yet, according to Vanguard's 2024 How America Saves report, roughly 28% of eligible employees contribute less than the amount needed to capture their full employer match. More than 1 in 4 people walking past free money every single month. Here's how it works in practice. A common structure is 50 cents on every dollar you contribute, up to 6% of your salary. If you earn $70,000 a year, 6% is $4,200 of your contributions. Your employer adds $2,100. That's a 50% immediate return before the market does a single thing. Over 30 years, at 7% average annual returns, that employer contribution alone, if captured every year, compounds to approximately $175,000. $175,000 left on the table because nobody bumped their contribution to 6%. By the way, hit subscribe if you're getting value from this. YouTube's algorithm determines whether to show my channel to new viewers based heavily on subscriber engagement. If you don't subscribe, there's a real chance you never see my next video, even if you'd want to. There's one wrinkle that trips people up on the employer match: vesting schedules. Your employer's matching contributions might not fully belong to you yet. Some companies use cliff vesting. You get 0 of the match until you've been there 3 years. Then you get 100%. Others use graded vesting. You earn 20% per year over 5 years. Check your plan documents. But in most cases, even with vesting restrictions, capturing the match is the right move. You're calculating expected value across a realistic employment tenure, not assuming the absolute worst case. Here's where most people make the next wrong turn. They think, great, I've got the match now, I should put more into the 401k. That's actually wrong. And the reason is one of the more interesting structural quirks in how these accounts work. In a moment, I'm going to show you a tax account that offers 3 distinct tax advantages simultaneously. It sounds made up, it isn't. First though, why your 401k is quietly overcharging you and how much that actually costs. The average 401k plan carries an all-in fee of roughly 1.02% annually, according to data from the Investment Company Institute. In a self-directed IRA, you can get the exact same market exposure, total US market, S&P 500, whatever you choose, for 0.03%. That's the expense ratio on the Vanguard Total Market Index Fund. The difference is roughly 1% per year. On a $200,000 balance over 30 years at 7% returns, that 1% fee difference costs you approximately $170,000 in lost compounding. Not in fees you see on a statement. In growth, that never happened because the money went to a fund manager instead of staying invested and working for you. I spent over a decade running a company surrounded by accountants and tax lawyers. And the thing that became clear fast is that the tax code is full of legal shelters that are only invisible to people who haven't read the documents. What I'm about to describe is one of the more obvious ones, once you see it. This is why level 4, after capturing your employer match, is to max your IRA before you contribute another dollar beyond the match into the 401k. An IRA gives you access to the entire investment universe. The 401k gives you a menu your plan administrator selected, which frequently prioritizes vendor relationships over cost efficiency. The IRA contribution limit for 2026 is $7,000, $8,000 if you're 50 or older. Roth or traditional. Here's the rough framework. If you're in a lower tax bracket now and expect to be in a higher one later, go Roth. Pay taxes on the seed, not the harvest. If you're in a higher bracket now and expect lower taxes in retirement, go traditional. Defer the taxes until you're paying a lower rate. If you're genuinely unsure, split it across both types. Tax diversification is underrated, and almost nobody talks about it seriously. Now, the thing I promised you, level 5. A health savings account accessible only if you have a high deductible health plan is the only account in the US tax code that delivers 3 simultaneous tax advantages. Contributions go in pre-tax. The money grows tax-free. Qualified medical withdrawals come out completely tax-free. Every other account gets 2 out of 3. The HSA gets all 3. The IRS built a near-perfect tax shelter and then placed it behind a requirement most people don't go looking for. Here's a parable. There's a city in Nevada where, for years, there was a free parking spot right outside a major casino. No meters, no tow zone, 40 feet from the entrance. Almost nobody used it because everyone filed directly into the parking garage they assumed was the only option. The garage cost $15. The spot was free. The HSA is that parking spot. It has been available this whole time. Most people drive straight past it. For 2026, you can contribute $4,300 individually or $8,550 for family coverage. Here's the advanced move that transforms the HSA from a good account into a genuinely exceptional one. Pay your current medical expenses out of pocket, if you can afford it, and leave the HSA money invested in the market. Keep every medical receipt there is, no time limit on reimbursements from an HSA. You can pay a doctor's bill today, file the receipt, and pull that exact reimbursable amount from your HSA 15 years from now, completely tax-free. The money compounded for 15 years in the market. The withdrawal is tax-free because it's reimbursing a documented qualified expense. You effectively converted market returns into tax-free medical coverage, retroactively. Max out HSA contributions for 25 years at 7% annual returns, and you accumulate approximately $280,000 in tax-free money designated for healthcare costs. According to Fidelity's 2025 retiree healthcare cost estimate, the average couple retiring today is projected to spend around $315,000 on healthcare throughout retirement. And HSA makes that entire expense nearly invisible in your retirement budget. That's not a marginal improvement. That's a structural shift in how your retirement works. A financial advisor once told me, completely straight face, that he doesn't bring up HSAs with clients because they're a bit complicated. An HSA, the account with a 4-minute setup form and 3 tax advantages. Complicated. You know what's complicated? Explaining to a client at 71 why they still have to work. That's a complicated conversation. After the HSA, you go back and fill the 401k. The 2026 contribution limit is $23,500. $31,000 if you're over 50. Between your IRA, HSA, and 401k, you can shelter over $35,000 annually from the IRS. That's the level where compounding starts running faster than you can consciously track it, and you stop checking the balance every other week because the math is doing the heavy lifting now. This is roughly the midpoint of the video, and I want to introduce someone I'm calling Dave. Dave is 43. He earns $82,000 a year. He's been investing since 34. He has a Robinhood account with roughly $31,000 in it, concentrated in 7 individual stocks he genuinely believes in. He also carries $14,000 in credit card debt, a mix of old balance transfers and one card that's been rolling since 2017. His employer offers a 4% 401k match. Dave contributes 2%. So Dave captures exactly half his match and leaves the other half on the table every single month. Dave's $14,000 in debt costs him approximately $3,080 per year in interest. His Robinhood portfolio returned 11% last year. That sounds impressive until you realize his credit card balance returned negative 23% on the same pool of capital in after-tax terms. Dave's net wealth position is being actively eroded while he feels good about his stock picks. Dave is playing level 6. Levels 1 and 2 are broken underneath him. The skill tree is inverted. I'm gonna come back to Dave. Now this is where it gets really interesting. Because everything so far, emergency fund, debt elimination, employer match, IRA, HSA, 401k, has been about clearing the board, removing the leaks, capturing the free money, filling the tax advantage buckets in the right order. But once you've done all of that, you reach the step that most people treat as step 1, the taxable brokerage account. And this is where the skill tree metaphor becomes darkly funny. Most people start here, right here at level 6, with nothing below them unlocked. They lose. They blame the market. They write blog posts about it. If you've worked through the first 5 levels, emergency fund built, high interest debt eliminated, employer match captured in full, IRA maxed, HSA maxed, 401k maxed, then the taxable brokerage is where everything else goes. That's a high quality problem to have. Most people never have it because they went to level 6 first and spent years recovering from the consequences. The taxable account has 3 specific advantages that don't get enough attention. No contribution limits pour in whatever your cash flow allows. No withdrawal age restrictions critical if you're targeting early retirement before 59.5, because accessing retirement accounts before that age without penalty requires workarounds. And the step up in basis when you die, your heirs inherit your taxable investments at the current market value, not your original purchase price. Capital gains you built over decades simply disappear from a tax perspective at inheritance. It's the most quietly generous provision in the tax code, and it almost never comes up in personal finance content. Let me walk you through specific numbers, because abstract math never lands as hard as a real scenario. Take someone named Alex. Alex is 36, earns $90,000 annually, and just finished paying off $11,000 in credit card debt over 14 months. For 2 years before that, he was putting $300 a month into a taxable brokerage account. His 401k was on the default enrollment at 3%, enough for a partial employer match, not the full one. Alex learns the sequence and makes 4 changes. He increases his 401k contribution to capture the full employer match, costs him an extra $140 per month out of take home after the pre-tax reduction, and his employer matches an additional $150 monthly. He opens a Roth IRA and contributes $583 per month to reach the $7,000 annual limit. He opens an HSA and contributes $358 monthly to hit the individual maximum. He pauses the taxable brokerage contributions. He doesn't have the cash flow for everything simultaneously, so he prioritizes the tax-advantaged accounts first. Run those numbers to age 67 at 7% annual returns. His 401k, including the employer match, approximately $940,000. His Roth IRA, approximately $720,000. His HSA, approximately $280,000. Total, approximately $1,940,000. What would he have accumulated following his old approach, 3%, 401k, no IRA, no HSA, $300 per month into a taxable account, losing roughly 1 percentage point annually to tax drag? Approximately $950,000. Same income, same decades, same market, different sequence, roughly $1 million of difference. That's not a rounding error. That's the entire retirement. Back to Dave. Dave eventually runs the numbers, pulls up his 401k plan documents, does the credit card interest calculation, and the thing that actually hits him isn't the big number at the end of a projection. It's this. He's been paying approximately $257 per month in credit card interest money going directly to a bank, producing nothing for him, compounding against him for over 6 years. He handed the bank somewhere around $18,500 in interest over that period. The bank's thank you was a credit limit increase offer. Dave clears the debt in 11 months by temporarily redirecting what he'd been putting into Robinhood, bumps his 401k to 4%, opens a Roth IRA. The Robinhood account stays open, he doesn't liquidate it, he doesn't blow up level 6, he builds levels 1 through 5 underneath it. Now those individual stock bets are things he can genuinely afford to lose because the foundation underneath them is solid. That's the only way stock picking actually makes sense as level 6, not level 1. My favorite genre of financial content is the person who puts $22,000 into options before they have an emergency fund, loses $17,000 of it, and then starts a YouTube channel about what trading taught me about myself. The lesson is you opened level 6 first. The lesson already has a name. It's called levels 1 through 5. Let me bring this back to where we started. $5,000 in median liquid savings, over $1.1 trillion in revolving credit card debt, 28% of employees not capturing their full employer match. These aren't random failures scattered across an unlucky population. They're what happens consistently when people try to play level 6 with nothing below them unlocked, when the skill tree is inverted, when the drain plug is missing, and everyone wonders why the tub isn't filling. Here are 3 specific, non-generic things you can do before you close this window. First, log into your benefits portal or call HR today, not next week, and find the exact match formula on your 401k. Write it down. Calculate the minimum contribution percentage required to capture the maximum employer match. If you're not at that percentage yet, change your contribution rate now. The compounding cost of a delayed decision here is not theoretical. It starts accumulating from this moment. Second, if you have a high deductible health plan and haven't opened an HSA, do it this week. Fidelity offers a zero-fee HSA with access to their full investment lineup. You don't have to max it immediately. Open the account, put in $500, and invest it in a target date fund. Most HSA holders make the mistake of leaving the balance sitting in cash inside the account it has to be invested to do anything. The account needs to exist and be working, not parked. Third, list your debts by interest rate, not by balance, not by which one makes you feel worst, by interest rate, highest at the top. Pay minimums on everything below that top item and concentrate every available dollar on the highest rate debt. You are not organizing your finances for emotional comfort. You are mathematically eliminating the item that is compounding against you fastest. The feelings are not the data. The sequence works because it follows the incentives and the math in the right order. Emergency funds stops the behavioral bleeding. Debt elimination locks in a guaranteed return that outperforms most active fund managers. Employer match doubles your money before the market touches a single dollar. IRA and HSA use the tax code to shelter decades of compounding from the IRS. And the taxable brokerage account, the thing everyone wants to start with, becomes genuinely powerful when everything underneath it is built. Lazy investing built more fortune than crypto memes. The people who got there never had to recover from anything. They plugged the drain, cleared the debt, captured the match, filled the buckets, and went on with their lives. The people who skipped straight to level 6, they're still playing, still starting over.